What's going on? Welcome. My name is Lysandra Everett. And if you're watching this video, you want to know how much money you should save for taxes for your super affiliate network income. Okay. So, all right, so let's get down with the get down. So first of all, if you don't know, if you've never watched one of my videos, I'm an affiliate marketer, but I'm also a tax professional. I'm an enrolled agent, which means that that is the highest certification awarded by the IRS. I studied tax code. I took a 3-part exam and passed, and that's what an enrolled agent is. So, what makes me qualified to share this with you is that, like I said, not only am I a tax professional, I'm an affiliate marketer. Now, I will also say that this video is not intended to be tax advice. While I am a tax professional, I am not your tax professional. So I highly recommend that you connect with a tax professional regarding your particular situation. Okay. So let's talk about managing this money. All right. So super affiliate network, and really, if you are bossing it out online, period. Okay. But super affiliate network offers you the opportunity to make lots of money. There are plenty of people who have 6-figure incomes in the super affiliate network. That is not a guarantee of income, but just to let you know what's possible. But the thing that comes with earning large sums of money is a tax bill. Okay. Now, I'm a tax professional in the United States. You may be watching this from another country. Then you would also need to consult with a tax professional from your country. But we know that there is taxes that's going on. Okay. So, so the big question that people ask is, how much should I save for taxes? So I'm going to share my screen here because I kind of like to talk and type at the same time so that I'm really, making sure that you see what is going on as well as hearing my voice. Okay. So I'm going to, all right. So first of all, you should save 30% of your gross income for taxes. Okay. Gross income. That is the amount of money that you earn. All right. So if you get a check for $1,000, then you should be saving $300 for taxes. So if you get $1,000 payment, save $300. Okay. Now, and most people want to know, okay, why do I have to save so much? Okay, so first you have federal income taxes. You have, you may have self-employment taxes. You have state taxes, state income. 43 states in the United States has income tax. Okay, so 9 times out of 10, you have a state income tax. State income tax. Some places have local income tax. There's a business privilege tax, and it's just that. It's an additional amount that you pay annually, based on, it could be based on your income, your gross sales, your profits, whatever. There's, that business privilege tax that you have to pay. Depending on whether or not you have an LLC, you have an annual filing requirement, and there's usually a fee with that. With different states is a different amount, where the state of Massachusetts is $500. Other states could be as low as $30. So you have to know that for your state. So when you're saving that 30%, you're saving for all of these things here. Self-employment tax is 15.3% of your profit. Okay. Now, so this is why you're saving that 30%, because when it comes down to filing your taxes, okay, if your tax liability is $1,000, is less than $1,000, you will just be able to write a check and keep it moving. However, if you have a tax liability of $1,000 or more, personal. Okay. And so what I mean is this: if you are filing, if you are a sole proprietor, if it's just you and your business, you haven't formalized your structure into, an S corporation or a C corporation, a partnership or anything like that, or if you have a single member LLC, then you're still going to be filing. This is going to be on your personal taxes. Okay. This is going to be on your 1040. Okay, so if you have a tax liability of $1,000 or more, then you're going to have estimated tax payments. Okay, so now what happens is at tax time, then if you wind up having that tax liability of $1,000 or more, you're going to have that tax liability to pay, as well as your first quarter estimated tax payments. Your Q1 estimated tax payment is due April 15th normally. Okay, your Q2, June 15th. This is some extra right here. Your Q3 is September 15th, and your Q4 is January 15th the following year. Okay? Following year. So where people get hemmed up is this Q1. So if you have $1,000 of a tax liability, and then you might have $250 of estimated tax payments. So come tax time, you would have to pay this $1,000 tax liability plus that additional $250 for your Q1 estimated tax payments. So now you can see why you save this 30%, because it's possible that you're going to have to write 2 checks at tax time, and you want to be able to have the money set aside to do that, okay? So that you don't get caught up being in debt to the IRS and having to work out payment plans and, having to pay interest and penalties and all of that, because that stuff can add up. The penalties and the interest is compounded. It's compounding interest, and it's added daily. So every day you don't pay your tax bill, that's more and more money that's being added every single day. Okay. So that's why you need to save 30% of your gross income for taxes. Okay. It's not that, this is a world according to Lysandra. It's just that I know that, home business owners are the first ones to wind up in trouble when it comes down to taxes, because there's lots of people, out here telling you how to make money. That's what I do. I tell you how to make money. I tell you how to, build a profitable business, and I tell you how to keep your money. Okay. So this is one of the things that helps you to keep your money and to stay out of trouble with the freaking IRS, because, like I said, there's lots of people telling you how to make the money, but there isn't a whole lot of people that's on the back end telling you how to keep and manage your money. Okay. It makes no sense for you to go out and make all this money and then wind up in debt to the IRS. And then, you've got to pay more money. Okay. So that is why you need to save 30% of your income for taxes. So if you would, discipline yourself to set that money aside immediately in a separate bank account with no with no debit card or anything, that is the money that is set aside for your taxes. So at tax time, if you need the money, you have it. And if you wind up not needing all of the money that you saved, then great. You can, start saving for taxes the next year, or you can reinvest in your business, or you can even pay yourself. Okay. So I hope this really helps you out. If you want to get access to the Super Affiliate Network system, if you're watching this, you're not a part of our team yet, then I invite you to click on the link that's in the description box and check out the program for yourself. All right. Have a fantastic day, and I will see y'all next time. Bye.